Malcolm, I'll begin with you. Your take on the Fed, the CPI, and just basically the next couple of weeks and where we go.
Morning, Brian. I'm not sure just how much today's CPI is actually going to have bearing on what Powell comes out and says tomorrow, because I have to imagine that they've already had quite, by they I mean Powell and his governors, they've already had quite extensive conversation both in public and also behind the scenes, and probably very late at night, one-on-one, when folks are texting and calling him to have the last word in the room before it's all said and done. And so I think the markets feel very fragile right now is the word that I would use. So much hinges on what Powell has to come out and say on Wednesday. And so far, the data showing signs that inflation is cooling, which investors are reading as an indication that the Fed's going to ease up on rate hikes. But it just seems like we're so hanging on a thread here, waiting on what Powell comes out and says, that we're not really going to have any idea what direction the market's going to move until we get this behind us.
You know, Aaron, excuse me, I was in Europe last week where I came back just sensing the people there were in pretty rough shape. I mean, nobody was optimistic. A lot of giant recession fears there, given what they're facing. And I kept back thinking, like, man, we're so obsessed with inflation. I get it. And the Fed, shouldn't we be more focused on a possible recession in Europe and or here? I mean, isn't that kind of the point?
Yeah, I think that is becoming much more at the forefront. And we've seen just in the past 5 to 8 trading days where we see people being a little more triggered by macro data that reflects recession possibility versus inflation. I think right now, just looking, you just showed the CPI chart. We've had 5 months of it coming down slowly. I know it's not soon enough for some people, but it is definitely on the downtrend. And now, obviously, the real fear is, can the Fed navigate this, and are we able to come out of this without a severe recession? And I think some of the news around companies either in the hiring freeze and also letting go of people, particularly in the tech sector, is a real concern. So seeing weakness in wage growth, seeing weakness in job openings, that's something that I think the markets are really going to be keying on to into 2023 versus being concerned about every single detail within the CPI report.
Yeah, that's it, Malcolm. And if we have a slowdown next year, which is likely, maybe we have a technical recession next year. We can debate that all day long. We'll have to wait and find out. What does that do to the equity market? Or is that recession and or significant slowdown, whatever you want to call it, is that already priced in? In other words, has this lousy year for most stocks, is that the result of what people are looking at 9 and 12 months from now?
Yeah, I get where you're going, Brian. I think we're actually closer to the end of this than we are to the beginning. And I know that's kind of the obvious, but the sentiment out there is so negative right now that I think it bears repeating, just because once we get to a place where capitulation, that C word, has come in and everybody you talk to is negative on the markets, that's usually a very good indication and a rear-looking spot where we look at the graph and say that was the point where we turned the corner. I really feel like we're already there. And what we do also know to be true is that the S&P tends to turn positive 4 or 5 months before the broader economy starts to show signs that it's improving. And so this could be that inflection point that we're talking about, where the markets have already started to turn and all of the bad news that we could possibly get related to this economy has already been sort of wrung out of the rag, if you will. And now we just need to suddenly see ourselves turn more positive on the markets and start to buy back, turning into the first quarter of next year, which I do think is very likely.
Well, let's talk about another C word, and that is consumer, because Aaron, and end on an optimistic note and get some pics from you guys. I'll tell you what, you guys all probably travel a lot. I've been living at the airport lately, and there's a lot of concern about slowdowns in spending on Amazon and department stores. I get that. There doesn't seem to be a slowdown in spending on travel and experience. Maybe people are not buying stuff because they want to go places, Aaron. The number of people going through a TSA pre-check 2 days ago was the same level as it was pre-pandemic. In other words, it's all packed. Planes are packed. Hotels are packed. I'm assuming that's why you think Booking Holdings may be a good bet for our audience.
Yeah, so when you look at profit expectations for 2023, because obviously we're getting really close now, right now across the S&P 500, it is almost all negative revisions, where most sectors, most industries are coming down, and S&P 500 has come down from about 5% to 4.5% on profit growth expectations. So really contracting. The one area, the one industry where we're actually seeing revisions upward and very stable is hotels and resorts. For next year, looking at about 138% profit growth. Now that sounds amazing. Obviously, it's coming off of lows, but more importantly, the fact that it's being able to hold that expectation out of the other 90% of companies out there, I think is something that is really said for going forward into next year. Now, so even though we may be in a very macro environment for quite some time, and we're all worried about what the Fed says and lots of macro indicators, looking just back to fundamentals, I think this is one area that you can feel very safe in going into next year.